Welcome to Investing 101. Most millionaires became wealthy by investing and saving money before spending it, i.e., putting money away for a better future. No matter how much their annual salary may be, most millionaires put their money where it grows, usually in stocks, real estate, bonds, and other types of stable investments. Investing is a crucial component of wealth building, but navigating the world of financial markets require a basic understanding of key principle and investment options. This Investing 101 discussion includes investing principles such as diversification, allocation, and rebalancing portfolios. It also dives into popular retirement accounts like IRA, 401ks, and covers various investment choices, including Bitcoin, equity, bonds, real estate investment trusts, and also ETFs. Before we go any further, I would like to thank our current subscribers and our new subscriber. If you just joined the channel for the first time, please select the subscribe button. We're a small channel, yet growing. We've released several videos in this financial educational series. Starting in order, we have a video on savings, goal setting, budget, debt management, and this is our final series, which is Investment 101. So thank you for joining, and please don't forget to hit the subscribe button. Regardless of how much money you invest, let's talk about three main fundamentals. It's almost like the North Star of investing, making sure you stay focused and have a well-balanced portfolio. The three cornerstones are: 1, diversification. You want to make sure your portfolio is diversified. And then we'll also discuss asset allocation. And lastly, rebalancing your portfolio semi-annually or annually. The definition and importance of diversification involves spreading investments across different asset classes to reduce risk. It is the fundamental strategy to protect against impact of poor performing assets. Not all of your investments are going to do well. So the more stocks and the more assets that you have that are diversified help minimize your investment risk and protect against poor performing asset. You may have a stock that tank while you have another stock that does well for that particular performance year. Some strategies for diversification is allocating investment across stocks, bonds, real estate, and other assets. Geographical diversification to include international investment, emerging markets. These are all stocks that you can find in your typical brokerage account. Industry diversification also to avoid concentration of risk. Asset allocation. The importance of asset allocation is to determine the percentage of your portfolio allocated to different asset classes, whether it's 60% in stocks or 40% in bond. This is what we call asset allocation, based on your risk tolerance and your willingness to take risks. Of course, if you have a higher tolerance of risk, your asset allocation to equity will be much higher than bonds. Balancing risks and returns based on your goal and your risk tolerance is key. Dynamic asset allocation based on the market condition and economic outlook. You also have to keep in mind political and market influences at a macro level, the 30,000 feet view. An example of asset allocation strategy is a conservative allocation. More bond, less stock for capital preservation. Make sure you protect against your overall portfolio. You would have a higher concentration in bond and a less concentration in stocks. That is if you're very conservative and you want to make sure that you protect your overall balance of your investment. A more aggressive allocation would mean higher stock and less bonds for higher growth potential over a long period of time. A balanced allocation for a moderate risk return portfolio. And this would allow you to balance things out over the long term where you're not really subject to a high risk in any given period of time. Also, rebalancing. The purpose of rebalancing is to adjust the portfolio back to its original or intended target. You may have your equity portion of your investment, remember the 60-40? You may have your equity portion do very well in one performing year, maybe a 25% return. Now it looks like for the next year, since you were successful, that the portfolio is looking like 70% equity. So you'll take some of the wins from your equity portion of that 70% and rebalance it to your bonds to return it back to its true state of 40%, and then keep the remaining in your equity allocation, which is 60%. So you'll continue in the next previous performing year, continue to have that 60-40 relationship, 60 in equity and 40 in bonds. That's your targeted risk adverse goal, and that's how much you're willing to take risks, 60% in equity. So you want to maintain that even if you do well in a given year. You want to schedule these rebalancing quarterly, annually for reviewing. Sell overweighted asset like I mentioned, and buy underweighted ones to restore back to that targeted of 60-40. Also keep in mind tax implication when rebalancing your account. If you're going to take some of those wins from that equity portion, that's a taxable event. How long you hold your stock in your investment also plays a part as it relates to tax considerations. Now that we've discussed diversification, asset allocation, and also rebalancing portfolio, let's talk about the type of accounts that retirement funds are held in. Individual retirement account IRAs, they come in two different fashions. One is traditional IRAs, individual retirement account. Contributions here are tax deductible. However, the withdrawals are taxed on the back end. You also have what you call a Roth IRA. Contributions here are actually after tax. So after your net pay for your biweekly or monthly salary, you invest into a Roth IRA with your net availability of your fund, what you actually get in your bank account. Therefore, your withdrawals for your Roth IRA are tax-free when you're 59 and a half. And both of them have the same withdrawal limit in terms of age requirement of 59 years old and a half. Okay, let's move on to 401k or 403b, employer-sponsored retirement accounts. They also offer similar tax advantages like tax deductible at the end of the year. And some of your employers also provides a Roth 401k where you can contribute to that 401k at a tax-free requirement versus a tax deductible. After gross, you get your net pay, you can contribute to your Roth. Where when you withdraw your employer-sponsored account with your Roth 401k, it will be tax-free. And a quick discussion about limitation and for both of these accounts, an IRA, which is your individual retirement account, and your 401k. There are also some limitation on how much you can contribute per year. The IRA account contribution are much less than your 401k or your employer-sponsored retirement plans. Those retirement plans are usually $22,000 and higher, and then the limit increases on average every year. For your IRA account, those limits are around $6,500, and once again, they too increase per year based on what IRS puts out. So be careful, be mindful, take note of that, and you want to maximize both of those as much as possible. Yes, you can have a employer 401k and also contribute to a individual retirement account to increase how much money you put away or how much money you make tax tax deductible. Now, there's some stipulation of how much salary you make. There are some limitations on a IRA Roth account. Lastly, investment options. There's also what you call targeted funds for retirement investment. For instance, if you're looking to retire in 2040, they have the year that you can just select it, and then that basket of allocation will all come under that umbrella of 2040. It could be fixed income, it could be bonds, it could be stocks, or it can be REITs. It would just be rolled under an investment vehicle called 2040, and so on and so forth for 2050 and 2060. Recall, we spoke about asset allocation. Therefore, a lot of these retirement plan offerings already have a mix of investments for you, like that 60% equity, 40% bonds, or vice versa. Depends on how you select your options within your retirement account. You can get the asset allocation that is more favorable for your risk tolerance. Lastly, rollover and transfers. Rollover of retirement accounts when changing jobs. Transferring funds between different retirement plans is also available. Here's a list of investment choices. Bitcoin. Incorporating Bitcoin in a portfolio supercharges the diversification benefits. And Bitcoin ownership. Bitcoin is surely a consideration for long-term versus short-term investment. We spoke about diversification, asset allocation, and rebalancing. If you recall, in the top part of this discussion, we said those three areas are the fundamental of investing. Many investors are in search of a good diversification mix. Bitcoin actually increases the diversification benefits of any portfolio. Equities. Equity is really stocks. So when you hear the word equity, it's synonymous with the word stocks. Let's keep it simple. The basics of equity investing, owning shares in a publicly traded company, has a potential for capital appreciation and can earn you dividends. Bonds. Bonds are fixed income securities providing regular interest payments, also diversification benefits, and risk mitigation. One way to think about bonds is actually debt. Money that the federal government has borrowed from you with a promise and a full faith of the government to repay what they owe with interest. This is why it's one of the safest assets when placed in a portfolio. Real estate is a great investment to incorporate in your portfolio as well. You can do this one or two ways. You can either go buy some rental properties and deal with the hassle being a landlord, or you can simply invest in real estate investment trusts. Once again, these are REITs, and they are available in brokerage accounts like Robinhood or Charles Schwab, like the examples that I'm using throughout this discussion. Investment in real estate through publicly traded companies. You can earn passive income and potential for great capital appreciation. Also, we have exchange traded funds, ETF, investment funds that are tracked on the stock market and allows for more diversification benefits with low expense ratio. Next, there's mutual funds. Contrasting features of an ETF and mutual funds. Choosing the right investment vehicles based on individual preference and goals. So within a mutual fund versus a ETF, mutual funds, you can select your basket of allocation. You can select the equity or the stock, if you recall, or the type of fixed income, the bonds that you're shopping for. For instance, you got different type of bonds, government, city, you have state bonds, municipality. These are different types of bonds with different types of risks, of course, but all of which that can be found within a mutual fund. What the contrast here between ETF is one ETF contains a basket of pre-bought, if you will, assets within that exchange traded fund, but a mutual fund allows you to pick and choose and make your own asset allocation. So it gives you more control over your investment options. Investing is a dynamic and a financial journey that involves understanding the fundamental principle of utilizing retirement accounts effectively and making informed choices about diverse investment options. By incorporating strategies like we discussed today, diversification, allocation, and rebalancing, individual, which is you, can build a resilient portfolio aligned with your risk tolerance and your financial goal. This Investing 101 video concludes our 5 series of financial educational content. If you received any value from the information that we have shared, please don't forget to hit the subscribe button.